All right, guys, welcome to day 8 of the 30-day course. Long awaited. This video is going to be a beginner's guide to PDAs. So I'm going to be talking about fair value gaps, breaker blocks, and order blocks. Those are my 3 favorite PDAs. So that's what we're going to cover here. So let's get right into it. First things first, let's talk about fair value gaps. Now, what exactly is a fair value gap? So this is a 3-candle pattern, right? You have candle number 1 right here, candle number 2, and candle number 3, okay? Now, between these 3 candles, you're going to see a gap, right? There's going to be a gap between the high of candle 1 and the low of candle 3, right? And it is going to form a gap like this. The basis behind fair value gaps and the reason why they work is very simple. So this middle candle, candle number 2, moved way too fast, right, and closed, and it left unfilled orders sitting inside of this gap, right? Unfilled institutional orders. So the basis behind why these work is that once we form this gap and then come back down through and touch this gap like we did right here, these orders that were sitting here are going to fill and price is then projected to go back up, right? So that is the basis behind why these work in the first place, okay? So you guys can see we have a gap between candle 1's high and candle 3's low, so that becomes a fair value gap. Up here, you guys can see the same thing. We have candle number 1 and candle number 3. There's a gap between them, so this becomes a fair value gap. And then I want you to look over here. So this is candle number 1's high, right? And candle number 3's low. Notice how there is not a gap, right? So obviously we don't use that. This is another fair value gap. Candle number 1's high, candle number 3's low. There you go. You have a fair value gap again, right? So you want to get really, really, really good at spotting these. They're going to pop up all the time, right? You guys can see in this entire leg down, right? We don't have any fair value gaps, right? We don't have any except for down here. Candle number 1's low, candle number 3's high, right? And then you have a bearish fair value gap, right? So that's the basis behind fair value gaps and the reason they work. Now, let me show you guys how I pick certain fair value gaps and why certain fair value gaps are going to work. So if we're looking at the hourly time frame over here, and if you're looking at this range as a whole, for example, let's go back here. We're looking at this range. We want to take the 50% of this range, right? So we have the low and then we have the high, right? Up here is going to be your premium. And down here is going to be your discount. Why is that? Because there's the 50% level, right? This is the midway point of this range, right? From this low to this high, this is our 50% level, right? And then upstairs is your premium and downstairs is your discount, right? So when we're looking for longs, we want to be looking as close to this equilibrium level or underneath this equilibrium level as humanly possible. Now, in this specific scenario, we have this fair value gap that lines up almost perfectly with the 50%. This gap is in a discount. However, this gap already got used. So is that something that we look at? No, right? We want to look at unmitigated PDAs. Those are going to be the best ones, right? And the science behind that is very, very simple. If we've already pulled into this fair value gap, that means that these orders have been filled, right? Majority of them have been filled. So what's going to happen the second time this comes back around into this fair value gap? Do you think that it's logical for it to hold? Or do you think maybe because the orders are filled, it makes a little bit more sense for us to then go through and drop through this fair value gap, right? Very simple. That's why I look at unmitigated PDAs over mitigated PDAs. So we have this fair value gap here that's sitting very, very close to equilibrium. So this is the one that we put our focus on, right? And then we come down into the fair value gap. There you go. We touch the consequent encroachment, which is the CE, right? So you guys might be confused why I have this midpoint level. And if you want to add that to your charts, all you have to do is go to style and then add the middle line right here. And this middle line is going to be the CE or the 50%, the midpoint of this fair value gap. And the reason why we have that marked out is because this is a very, very strong level, okay? You can see Obviously, price does not just immediately touch the top of the gap and then reverse, right? While that is possible, it can do that. Most of the time, especially with higher time frame fair value gaps, it's going to come either do a full fill or it's going to be a consequent encroachment bounce. So the way that we, you know, give these a little bit more weight is by looking at buy side and sell side liquidity sweeps, right? So for example, we have sell side liquidity right here, and then we have price going through sell side liquidity right there, right? So price pushes through there and then immediate reversal. Now the gaps that are going to form here on the way back up, right, especially underneath that equilibrium level or close to that equilibrium level, are going to be the strongest ones. So this would be a strong one, for example, and you guys can see the move that it gave, right? We pushed into that fair value gap, touched again almost the midpoint, and then made a bounce, right? This one is another one. This is the next immediate fair value gap, and you guys can see we come down, we touch it, immediate push higher, right? So these are going to be the ones you want to look at, or you want to, on the inverse side, obviously you want to be looking at fair value gaps that are, that have swept buy side liquidity, for example. So over here, give you guys an example. We have buy side liquidity, right? Mark that out with buy side liquidity, and buy side liquidity gets swept. As soon as buy side liquidity gets swept, we create this fair value gap. It might not be that big, but it's there, right? Right there. Okay. And what happens when we pull up into that fair value gap? We get a big dump, right? And this is higher probability because we had a sweep of liquidity directly before that fair value gap was formed. Okay. So those are going to be the ones that you want to look at mainly, right? Another one that increases probability of said fair value gap is going to be something that lines up with either an order block or a breaker block, okay? This is going to be known as a unicorn setup. So, for example, this fair value gap here lined up with, this is a breaker block, right? This is a breaker. So, we'll have this as the, actually mark out, there we go. So it's easier for everybody to see. Mark out breaker, right? So we have a breaker, and then directly above the breaker, we have a fair value gap. So this is going to be higher probability. Why? Because there's two PDAs here, right? And we'll get into the breaker blocks in a second. You don't need to worry about that right now. I will explain these to you. But we have two different PDAs, right? So think of it as two different support levels instead of just one, right? So we're going to come down into this fair value gap. If somehow the fair value gap does not push us back higher, we have an immediate PDA lower directly underneath that can then push us higher as well. So this creates a high probability scenario for a move to the upside, right? So that is fair value gaps in a nutshell. I'll show you guys some more examples of these here as well. So this is an hourly time frame that I'm on. These are fractals, so you can use it anywhere on any time frame, right? First one that comes to my eyes, right? We have this fair value gap right here, and send that out. You guys can see we get a full fill of the fair value gap, and then an immediate move higher, right? Now this is the same fair value gap that I just showed you guys on the hourly. Now it's just on the 15-minute. It's a little bit more condensed, right? So you guys have that. And again, we have a sweep of a low, right? Before it moves to the upside, and then creates that fair value gap. So this creates a higher probability scenario here for said fair value gap, right? And if I keep going, I'm sure I can find a lot more than that. So over here, we've got two different examples. We have this leg higher, right? And the leg higher leaves a few different fair value gaps. Particularly what I want to focus on are these upper two gaps, right? And the reason why is because, again, you want to take the range from the low. So if we take this range from this low, right, from this low right here to this high right here, then we see that this equilibrium level, right, anything underneath that is going to be the high probability gap, right? So if we have this equilibrium level right here and directly underneath we have this fair value gap, then this is the one that we're going to be looking at as opposed to the one that's up here, right? Or all the way down here, because realistically this one should hold. And what does price do as it pulls down into here? It does two things. So number one, we sweep liquidity, right? We have that sell side that gets swept into the fair value gap, and we start getting a really nice bounce, right? And then again, we leave several fair value gaps. So we have this one here, and then we have another one to the upside. Now, how do you know which one you're going to use? Again, 50% of the range. So take it from this low, right? Take it to that high right there. And where's our 50%? It's in the right underneath the midpoint of this fair value gap, right? So we can delete this one because this is the one that we want to see hold. And what does price do? It comes down right into that 50% level, fully fills this fair value gap, right? And then immediate bounce to the upside and breaks the highs. Okay. So this is fair value gaps for you. Now let's go into order blocks, right? So let's just say we have a sell side liquidity level right here. Okay, this is our sell side, bottom of the range, and this is our buy side, top of the range, right? So buy side liquidity and sell side liquidity right there. Now, what we're looking for is a candle or a series of candles to sweep either the buy or sell side, in this case, sell side, right? We sweep the sell side and then immediately push higher and close above either that series or that one candle, okay? So in this case, where is the series or the one candle that broke the low? It's going to be these two down closes, right? These two down closes are the ones that broke the low. So once we close above these two down close candles, we now have an order block. So this would be our order block. So the way you draw them, a bullish order block is going to be from the top of the body to the bottom of the wick. This is how you're going to draw a bullish order block, right? There you go. There's your order block right there. If you want more visualized, here you go, right? Top of the body to the bottom of the wick. This is your order block. Now, the way you're going to use this is same as fair value gaps, right? We're looking for us to break to the upside, right? As soon as we close this candle right here above this candle, right? As soon as the green candle closes above this down close, in this case, we have white and blue, right? But as soon as this white candle closes above this blue candle, which is a down close, we confirm this order block, right? And then at that point, all you're looking for is a retest like this, right? And then you're looking to go long. So if I was to take this setup, this is what it would look like, right? And again, higher probability because we have a fair value gap inside, right? So the way this setup would look is I would take a entry right there, and you can, place a stop loss somewhere underneath this fair value gap, and we just simply target buy side liquidity. The main thing that I try to tell people, have this be a 2R minimum, right? You always want to have minimum 2R. So 2R for me would be like if I risked this low, right? Let's just say we risked that low, and this would be 2R, meaning we're risking $1 to make $2. This makes the most sense. You're not going to risk $1 to make $1, right? Like, no sense in doing that. So the minimum risk to reward you want to use is 2R, right? And here you go. You get tagged into your trade, and it takes a little bit, but it moves up straight into the buy side liquidity level, and there's your 2R trade fully complete, right? Now, here's another scenario where the sell side liquidity level is based off of a PDA, right? So remember, PDAs are also levels of liquidity or areas of liquidity. It doesn't just have to be highs and lows. So in this case, we have a fair value gap right here, right? Price pulls into this fair value gap. Now, where are the candles or candle that broke the low into the fair value gap? It would be these two down closes, right? So these two pushed down into this fair value gap. So these two become the order block, right? And as soon as we close above right here, right? This candle closes above. So it confirms these two as an order block. So we want to draw it from the top of the body right there to the bottom of the wick. And there you go. You have your order block, right? Let's extend that out. And all we're waiting for is a retest of this order block to then potentially go long. So we have our retest right here. You want to long the order block. And let's just say we have a stop loss at this low, right? And then we want to target the opposing side of liquidity. In this case, you can either target the highs, right? The highs, or, and this is, we're going to get a little deep here, but this is another order block up here, right? Another order block. I'll get into that in a second. So let's just say I'm going to target this order block. We need at least a 2R, so I'm just going to adjust this stop loss just a tiny bit just to get to 2R and send that out. There you go, right? 2R complete, trade has been hit. Okay, so now we can remove this order block and remove this fair value gap because obviously, like I just said, because they've already been used, we remove them. I don't put much focus on mitigated PD arrays. And then we have, let me explain to you guys this one up here. We have a buy side liquidity level right here, right? This swing low or swing high is a buy side liquidity level, right? This one and this one, buy side. And also, by the way, there's another order block inside of here as well for your study. But we have buy side liquidity level right here. Where is the candle or candles that broke the high? This one right here, right? This up close. As soon as we close underneath this up close on this, we create an order block, right? So this is going to be our order block. And again, for bearish order blocks, it's going to be opposite to what we drew. So we're going to draw bottom of the body to the top of the wick. Okay. So there you go. Bottom of the body to the top of the wick. Here's our order block. Let's extend that out. And obviously we want to be short inside of this order block, targeting an opposing side of liquidity, you know, blah, blah, whatever. You guys get the point there. So let's just say we got our entry in right here at the order block. We want a stop loss, you know, generally near the highs, and we want at least a 2R out of this. Let's just say I want to target this and I want to stop up there. That gives me a 3.62. That's okay, right? If it's over a 2R, that's totally fine. 2R is just the minimum, okay? Let's just say I wanted to target a 2R. I mean, that's going to get hit for sure, right? Like, it already got hit there. So, there you go. And there's your full trade complete. All I did was target this opposing side of liquidity right here, which is going to be your sell side, right? Sweep buy side, create the order block straight into sell side. Now, had we over here, had we pushed all the way up and closed above these 3 down close candles, these 3 down close candles are the ones that made the new low, right? They swept this low. So if we had closed above them, then this series of candles would become one order block. So from that high, right, from the top of the body to the bottom of the wick, this would become one order block. Obviously, we have not closed above them yet, right? We're just kind of chopping around. So we don't have an order block here yet, right? But that's order blocks for you. Now, more often than not, whenever you have an order block, it's also going to create a breaker, right? So this was an example we just used of an order block, right? This is the high of the order block. This is the low of the order block, right? Right before that, we have an up close candle. Okay, this up close candle is our breaker block, and you're going to draw it the same way. You're going to draw it from the top of the body to the bottom of the wick. There you go. We'll extend that out, and this becomes our breaker, right? Now, this is essentially, think of it as an up close candle that we were once trading underneath, like this, right? We were trading underneath it. We swept into a PD array, or we swept a high or a low. We closed above it like this, right? This becomes a breaker now, okay? So retest of this is going to push us higher. All right, and this area is higher probability because not only do you have the breaker, but you also have a order block. Okay, and more often than not, there might also be a fair value gap. So in this case, we have a fair value gap as well. So 3 stacked PD arrays. All 3 PD arrays we talked about, we have them right here. And as you can see, there you go, right? And that's why it makes this high probability because you have 3 different stacked PD arrays. So that concludes the introduction to PD arrays video.